What if I told you that turning 65 could quietly raise your taxes without Congress passing a single new tax law? What if I told you that most retirees don't realize it until they open their bank account and see their Social Security deposit is hundreds of dollars lighter than they expected? Turning 65 is supposed to be a milestone. Medicare, retirement, finally enjoying the money you worked your whole life for. But behind the scenes, a hidden system kicks in, one that punishes you for having too much income at the wrong time. It isn't called a tax. It doesn't show up on your IRS Form 1040, but it absolutely drains your retirement income directly from the source. Today, we're talking about the income-related monthly adjustment amount, better known as IRMAA. We're going to break down the specific 2026 numbers, the cliff that can cost you thousands, and exactly how this money gets taken from your Social Security check before you ever touch it. And by the way, if you're anywhere near retirement, this channel is all about helping you keep more of your money. So take a second to like this video and subscribe. It really helps get this information in front of the people who really need it. If you're approaching 65 or if you're already on Medicare, you need to understand the relationship between your tax return and your Social Security check. Here's the reality. Medicare is not free. Most people expect to pay a standard premium for Part B, which covers doctors and outpatient services. But for millions of Americans, that standard premium is just the starting point because Medicare is means tested. The government uses a surcharge system to collect more money from higher earners. That surcharge is IRMAA. And the most dangerous part of IRMAA isn't just the cost, it's how it's collected. Unlike a bill you can ignore for a few weeks, IRMAA intercepts your income. It's deducted automatically from your Social Security benefit. If you don't understand how this math works, you cannot effectively budget for retirement. By the end of this video, you'll understand the official 2026 thresholds and premiums based on your 2024 income, the cliff effect that makes earning $1 extra a financial disaster, how the Social Security deduction actually works, and how to legally shield your income to avoid these surcharges. Before we look at the specific dollar amounts for 2026, we need to talk about how the government actually gets this money from you. For most retirees, you don't write a check to Medicare. You don't log into a portal and pay a bill. Instead, the Social Security Administration acts as the bill collector. Here's the equation you need to understand. Your gross Social Security benefit minus Medicare premiums equals your net deposit. If you're paying the standard amount, the deduction is predictable. But if you trigger IRMAA, that deduction grows. Social Security calculates the surcharge and stacks it on top of your standard premium. Both amounts are combined into a single deduction that comes out of your check before it ever hits your bank account. This is where people get blindsided. You might be expecting a cost of living adjustment, a COLA increase, to your Social Security. But if you trigger a higher IRMAA tier, that surcharge can eat up your entire raise and then some. Your gross benefit can go up while your net spendable income goes down. If that sounds frustrating, hit the like button. You're definitely not alone, and this is exactly why this stuff needs to be talked about more. Now, if you're not collecting Social Security yet, maybe you retired at 65 but plan to wait until 70, you'll get billed directly by Medicare every quarter and have to pay out of pocket. But the moment you turn on Social Security, the automatic deductions begin. And if your Social Security check isn't large enough to cover the premiums, Medicare will deduct what it can and bill you for the rest. You cannot opt out of this. So how does Social Security know how much to deduct? This is where the hidden tax really shows itself. IRMAA uses a 2-year look back. This is the most important concept to understand. The premium you pay in 2026 is not based on your 2026 income. It's not even based on your 2025 income. It's based entirely on your federal tax return from 2024. That means decisions you made 2 years ago are determining your cash flow today. Did you sell a rental property? Do a large Roth conversion? Take a big capital gain? The IRS shares that data with Social Security. If that income pushed you over the line, you will hit the surcharge 2 years later. And they don't use your regular adjusted gross income. They use something called modified adjusted gross income, or MAGI. For Medicare, MAGI is your AGI plus tax-exempt interest. So if you thought municipal bond interest was completely safe because it's tax-free, think again. It may be tax-free for the IRS, but it counts against your IRMAA. That's why this feels like a hidden tax. It punishes income you earned years ago and targets money you thought was protected. Now, let's get into the 2026 numbers. If you are single with a modified adjusted gross income up to $109,000 or married filing jointly up to $218,000, you're in the clear. You pay the standard Medicare Part B premium for 2026, okay? That amount's projected to be $202.90 per month. That's $202.90 coming straight out of your Social Security check. But the moment your income goes $1 over those limits, $109K for singles or $218K for couples, you fall into the first IRMAA tier. Your premium jumps to about $284 a month. That's roughly $81 more per person every month, or nearly $1,000 per year. For a married couple, that's about $2,000 gone. Quick reminder, if this breakdown is helpful, make sure you're subscribed. We go deep on retirement taxes and Medicare traps that most people never see coming. And it gets worse as income rises. The next tier jumps to $405.80 per month, then $527, then $649. And at the top tier, singles over $500,000 or couples over $750,000, you're paying $689.90 per person per month. And this is before your Medicare supplement plan. Notice the shape of these increases. It's not a smooth ramp, it's a staircase. That's the cliff effect. If a married couple earns $218,000, they pay the standard rate. If they earn $218,001, both premiums jump. One extra dollar can cost nearly $2,000 in additional Medicare premiums. This is why retirement tax planning is not optional. Accidentally selling a stock or taking a small extra distribution can trigger a surcharge that wipes out the profit you just made. And we're not done yet. IRMAA also applies to Part D, your prescription drug coverage. If you cross the income thresholds, you'll pay an additional surcharge on top of whatever your drug plan already costs. Those surcharges range from about $14.50 to $91 per month. Most of the time, the Part D IRMAA surcharge is also deducted from your Social Security check, but sometimes it's billed separately. If you assume it's being auto-deducted and you ignore that bill, you can lose your drug coverage. That's why you have to read your Social Security notice of award carefully. Let's make this real. Meet Alicia and Bob in 2024. They managed their income very carefully. Their modified adjusted gross income was $215,000. Because they stayed under the $218K threshold, they each pay about $202 per month for Part B. That's $405.80 total for the household. Now, meet Kathy and Dan. Their finances look almost identical, but they withdrew a little extra from their IRA for a home renovation. Their modified adjusted gross income came in at $219K, just $1,000 over the line. But because of that, they both fell into the IRMAA tier. They each pay about $284 per month. Their household cost jumps to $568.20 per month. That's $162 more every single month, or nearly $2,000 per year. They earned $1,000 more but paid $2,000 in penalty. That is the IRMAA trap. But the good news is you're not stuck with this forever. IRMAA is recalculated every year. Lower your income and the surcharge disappears 2 years later. There's 3 powerful ways for you to fight back on this though. First, Roth conversions. Doing these strategically, especially before age 63, can reduce future required minimum distributions and keep your income lower later. Second, qualified charitable distributions. If you're over 70 and a half, you can donate directly from your IRA to charity. It satisfies your required minimum distribution and keeps that money out of your MAGI. Your third option is the appeal. If income dropped because of a life-changing event like retirement, divorce, or death of a spouse, you can file Form SSA 44. You're asking Social Security to base your premiums on your current income, not your old tax return. If approved, your premium can be lowered immediately. But here's the bottom line. Turning 65 doesn't automatically raise your taxes, but IRMAA absolutely can. And it does it by taking money directly out of your Social Security check before you ever even see it. Your retirement strategy isn't just about how much you save, it's about how much you show on your tax return. If this video helped you avoid the IRMAA cliff, hit that like button so more retirees see it. Subscribe if you want more clear, no-nonsense strategies to protect your Social Security. And drop a comment below. Have you ever been hit by a surprise IRMAA bill? I'll see you in the next one. Thanks for watching.